it comes to bailouts of American business, Barney Frank and the Congress may be just getting started. Nearly $2 trillion tax dollars have been shoveled into the hole that Wall Street dug, and people wonder, where's the bottom? It turns out the abyss is deeper than most people think, because there is a second mortgage shock heading for the economy. In the executive suites of Wall Street and Washington, you're beginning to hear alarm about a new wave of mortgages with strange names that are about to become all too familiar. If you thought subprimes were insanely reckless, wait till you hear what's coming.
What's the future hold? Well, this shows...
One of the best guides to the danger ahead is Whitney Tilson. He's an investment fund manager who's made such a name for himself recently that these investors, who manage about $10 billion, gathered to hear him last week. Tilson saw a year ago that subprime mortgages were just the start.
We had the greatest asset bubble in history, and now that bubble is bursting. The single biggest piece of the bubble is the U.S. mortgage market, and we're probably about halfway through the unwinding and bursting of that bubble. Halfway. It may seem like all the carnage out there, we must be almost finished, but there's still a lot of pain to come in terms of write-downs and losses that have yet to be recognized.
In 2007, Tilson teamed up with Amherst Securities, an investment firm that specializes in mortgages. Amherst had done some financial detective work, analyzing the millions of mortgages that were bundled into those mortgage-backed securities that Wall Street was peddling. It found that the subprimes, loans to the least creditworthy borrowers, were defaulting. But Amherst also ran the numbers on what were supposed to be higher quality mortgages.
And they were frankly terrifying as data we'd never seen before, and that's what made us realize, holy cow, things are going to be much worse than anyone anticipates.
The trouble now is that the insanity didn't end with the subprimes. There were two other kinds of exotic mortgages that became popular, called Alt-A's and Option Arms. The option arms in particular lured borrowers in with ultra-low initial interest rates called teaser rates, sometimes as low as 1%. But after 2, 3, or 5 years, those rates reset. They went up, and so did the monthly payment. So a mortgage of, say, $800 a month could easily jump to $1,500. Now the Alt-A and option arm loans made back in the heyday are starting to reset, causing the mortgage payments to go up and homeowners to default.
The defaults right now are incredibly high at unprecedented levels, and there's no evidence that the default rate is tapering off. Those defaults almost inevitably are leading to foreclosures and homes being auctioned and home prices continuing to fall.
What you seem to be saying is that there is a very predictable time bomb effect here.
Exactly. I mean, you can look back at what was written in 05 and 07, you can look at the reset dates, you can look at the current default rates, and it's really very clear and predictable what's going to happen here.
Just look at this projection from the investment bank of Credit Suisse. These are the billions of dollars in subprime mortgages that reset last year and this year. Now look at what hasn't hit yet. The Alt-A and option arm resets when homeowners will pay higher interest rates in the next 3 years. We're at the beginning of a second wave. How big is the potential damage from the Alt-A's compared to what we just saw in the subprimes?
Well, the subprime was approaching $1 trillion. The Alt-A is about $1 trillion. And then you have option arms on top of that. That's probably another $500 to $600 billion on top of that.
How many of these option arms would you imagine are going to fail?
Well north of 50%. My gut would be 70% of these option arms will default.
How do you know that?
We know it based on current default rates, and this is before the reset. So people are defaulting even on the little 3% teaser interest-only rates they're being asked to pay today.
That second wave is coming ashore at a place you might call the Repo Riviera, Miami-Dade County. Oscar Munoz used to sell real estate. Now his company clears out foreclosed homes.
Business is just going through the roof for us. Fortunately for us, unfortunately for the poor families who are going through this.
I wonder, do you ever come to houses where the people are still here?
Absolutely. That's really a sad situation. I'd rather not meet the people.
Why not?
It's not easy to come in and move a family out. It's just our job to do it for the bank. It's just the nature of what's going on in the market right now.
What is going on in the market right now? How much work are you getting?
Every day we have 20, 30 assignments.
A day?
A day.
Just your company?
Just our company. And we're one of the few companies right now who are hiring. We have to hire people because the demand is so high.
People who've been evicted tend to leave stuff behind. The next house is usually much smaller. Banks hire Munoz to move the possessions out where by law they remain for 24 hours. Often the neighbors pick through the remains. Once the homes are empty, the hard part starts, trying to find buyers in a free-fall market. Miami real estate broker Peter Zalewski talks like a man with a lot of real estate to move.
We have 110,000 properties for sale in South Florida today, 55,000 foreclosures, 19,000 bank-owned properties, 68% of the available inventory is in some form of distress. They need someone to clean it up.
What's the name of your company?
It's called Condo Vultures Realty.
What does that mean?
That in times of distress and times of downturn, there's opportunity. And vultures are cleaning up the mess. A lot of people seem to think they kill, but they don't actually kill, they clean.
They stopped checking whether the income was even real. They turned to low and no doc loans, so-called liar's loans, and jokingly referred to as ninja loans. No income, no job, no assets, and they were still willing to lend.
But help me out here. How does that make sense for the lender? It would seem to be reckless in the extreme.
It was, but the key assumption underlying the willingness to do this was that home prices would keep going up forever. And in fact, home prices nationwide had never declined since the Great Depression.
On the way up, everyone wanted in. No one expected to feel any pain. This Miami luxury building was a sellout, but when we visited, a quarter of the condos were in foreclosure.
What did this place go for?
This was originally purchased in October of 2006 for $2.4 million.
$2.4 million? What's it worth now?
The asking price from the lender is $939.
So it lost $1.5 million in value in a couple of years?
It was a tough 2 years.
And there are tough years to come, because just like the subprimes, the Alt-A and option arm mortgages were bundled into Wall Street securities and sold to investors.
In a nutshell, 2009 looks like what to you?
Miserable.
2010?
Miserable, even worse.
Sean Egan runs a credit rating firm that analyzes corporate debt. Fortune magazine cited Egan as one of 6 Wall Street pros who predicted the fall of the financial giants.
This next wave of defaults, which everyone agrees is inevitably going to happen, how central is that to what happens to the rest of the economy?
It's core. It's core because housing is such an important part. We're not going to get the housing industry back on track until we clear out this garbage that's in there.
That hasn't cleared out yet.
In fact,
we haven't seen the bottom.
It's getting worse.
What do you mean?
There are some statistics from the National Association of Realtors, and they track the supply of housing units on the market, and that's grown from 2.2 million units about 3 years ago up to 4.5 million units earlier this year. So you have the massive supply out there of units that need to be sold.
Well, with the housing supply increasing that much, what does it mean?
It means that this problem, the economic difficulties, are not going to be resolved in a short period of time. It's not going to take 6 months. It's not going to take 12 months. We're looking at probably about 3, 4, or 5 years before this overhang, the supply overhang, is worked through.
In the next 4 years, 8 million American families are expected to lose their homes. But even after the residential meltdown, Whitney Tilson says blows to the financial system will keep coming.
The same craziness that occurred in the mortgage market occurred in the commercial real estate markets, and that's taking a little longer to show, but there are going to be big losses there. Credit cards, auto loans, you name it. So we're maybe halfway through the mortgage bubble, but we may only be in the 3rd inning of the overall bursting of this asset bubble.
The stock market will still have a lot of figuring to do, with more troubling news on the horizon. The Mortgage Bankers Association says 1 out of 10 Americans is now behind on their mortgage. That's the most since they started keeping records in 1970.